Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa. If you find this video helpful, please press the like button and don't forget to subscribe to see our upcoming market reviews.
Good day and welcome. I am Nick from the Overberg Greyton office. We are glad that you can join us.
So isn't it strange that in May, the saying goes, sell in May and go away. Of course, the markets never quite behave the way you expect them to. This year, I think quite the opposite strategy would have been far better. Buy in May and go away. So since over the last 2 to 3 weeks, the S&P 500 has gained by about 7%. After yesterday's gain, even more, I should say 8% probably. We've had a very strong rebound across global markets. And the million-dollar question, is this a bear market rally, or have we already seen the bottom in the market? So Overberg Asset Management, we distill a lot of research, a lot of reading, and our feeling is that we haven't hit the bottom yet. We're very close to the bottom on a time horizon. It could be that the bottom only occurs at the end of this year or possibly even the beginning of 2023. But in any event, in percentage terms, we're probably quite close to the bottom. So whether we have already seen it or we haven't, either way, the outlook is getting increasingly positive. Most of the pain has been felt already. So this morning we're going to be talking about the macro. I'm going to start off with a nice piece from Capital Economics. Their outlook isn't particularly bullish. They say that the global economy faces a more difficult outlook than most expect. The US, Eurozone and China face challenges that are all very different from each other in nature and scale. The US, they expect the economy in the US as a whole to skirt recession. Nonetheless, it is likely to slow as the Federal Reserve continues to tighten monetary policy. They anticipate a period of below-trend growth into 2023. However, the slowdown in the US is likely to be relatively mild compared to other advanced economies. Europe's economic ties to Russia, being a net importer of energy and due to a severe deterioration in its terms of trade, is going to suffer a large squeeze on real household incomes. Meanwhile, core price pressures are building and policymakers must focus on bringing inflation to heel. So it's incredible. In Europe, we've got inflation at 8.1% and the ECB's interest rate, benchmark interest rate, minus 0.5%. So there's a lot of scope for monetary tightening in Europe. China's problems are even more complex due to Omicron outbreaks, strict lockdowns, and then mounting cyclical headwinds. The property market won and fading global demand for Chinese produced goods. Chinese structural economic problems are also deepening. Decoupling between China and the West, regulatory issues, and then of course policy support has been small by past standards. And of course, we mustn't forget that if a country does become uninvestable, and that is part of the debate about China, the PE rating drops substantially. And an example there is Russia. So even before they even contemplated the invasion of Ukraine, the PE of the Russian index used to be in a range of 4 to 6 times. So a very substantial de-rating. Bank credit analysts have got an economic review of the Chinese market. The Chinese economy faces a trifecta of economic woes: the threat of renewed COVID lockdowns, cooling export demand, and the floundering housing market. So I'm not going to go into all the details there, but I just will pick out an interesting statistic on the property market. So this is Goldman Sachs. They estimate that the default rate for property developers will reach 32% in 2022, up from their earlier estimate of 19%. So that is a big increase in the default rate forecast. And by the way, the entire Chinese housing stock is worth nearly $100 trillion, making it the largest asset class in the world. The decline in Chinese home prices would generate a sizable negative wealth effect. But there is light at the end of the tunnel because of these problems and because of the fact that China has got its 20th Party Congress later this year. There's a very strong political incentive to get the economy on an even keel. And how best to do that is to reorient the economy away from its reliance on investment and exports more towards consumption. And the best way of achieving that is to adopt a helicopter drop of cash on consumers in the same way that Europe and the US did during 2020 and 2021. So that's on the economy. Let's look at monetary policy. Just a quick review of the different regions in the world and what their monetary policy is. The ECB kept its policy rates unchanged at its April meeting, but the ECB also announced the end of net asset purchases under the PEPP program. So that is the opening salvo for a slow migration back towards normal monetary policy settings. And then we've got the BOJ. In Japan, still battling with decades of deflation, the BOJ maintained its hyper-accommodative policy stance in late April, continuing with its policy of yield curve control. And they're continuing to purchase Japanese government bonds with a specific purpose of keeping 10-year bond yields, that's Japanese government bond yields, at around the 0% mark, regardless of the fact that global bond yields are rising. More hawkish, the Bank of England decided to increase its policy rate by 25 bips to 1% at its policy meeting in May. The policymakers highlighted that inflation is expected to rise even further over the remainder of the year to just over 9% in the second quarter, averaging slightly over 10% at its peak in the fourth quarter of this year. But policymakers in the UK have got a problem. There's a housing bubble and there are credit excesses, so they'll need to tread carefully that they don't burst that bubble and cause a recession. And then last, the US, probably most importantly, we all know that the Fed increased its target range for the Fed funds rate to a range of 0.75 to 1%. Policymakers note that they now expect a more rapid removal of policy accommodation than had been expected. So JP Morgan Cazenove, they say that to date there's been a tug of war between concerns over growth and policy. The growth policy trade-off might be turning less problematic in the second half of the year. Our call is that the Fed is reaching peak hawkishness and that view is starting to see traction. The evidence is lower Fed futures. The dollar rally is beginning to stall. interesting research from ECR on monetary policy. They feel that central banks will ultimately opt for higher inflation. They can't go all guns blazing to bring inflation down because of towering debts across the world. If they raise interest rates too quickly and by too much, then they risk causing a credit crunch. And they want to avoid that at all cost. So ECR expects central banks to ease monetary policy again just before a recession begins. So how does all of this relate to equity markets? There's an interesting article from the Financial Times. They're looking at the S&P 500 going back to 1926. That's almost 100 years. There have been 15 bear markets with a median drop of 34% over 17 months. In nearly 75% of these cases, selling paused noticeably when the market was down 15 to 20% from the peak. So currently where we are now, reversing some losses before resuming the trip to the bottom. This suggests that we are witnessing the intermission stage of a bear market. And then, since 1926, there have been 5 cases separate from the bear markets in which stocks fell nearly 20% but did not cross that threshold. So that's exactly where we are currently with the S&P 500. In all 5, the market stopped falling only when the Federal Reserve intervened by loosening monetary policy. Clearly, that is not the case this time. So I think that is about it for the time being. Gielie, I think it's over to you at this stage.
Hi, Nick. Thank you for an interesting and comprehensive macro overview. Locally, a few things happened. FirstRand, we own FirstRand. In a trading statement for the year up to June 2022, they gave the bare minimum disclosure that they expect the earnings to be up by at least 20% than last year. At Raubex, there's been what they call insider buying of shares. Has been declared. It's just that the new CEO, Mr. Dirk Lourens, he's bought shares to the value of 1 million rand. This morning it was disclosed that Tencent is up 5%. And the reason for that is that China has approved 60 new online games. Foreign net buying and selling of shares, there's been net selling. It's really picking up now. At the moment, the net selling of shares year to date has been 5 billion rand. And then statistics. Car sales came out last week. New vehicle sales, 39,000 units were sold. It's up 2%. And exports, 25,000 cars were exported. That is actually down 30%. It's a lot. The car of the year this year, the results came out earlier this week, is the Toyota Corolla Cross. Car sales for the individual companies, Toyota, 6,000 units. And motors, we own motors. Motors mainly sells Kia and Hyundai vehicles. It's interesting, they've now passed Toyota as the best seller. They're the best seller in the country. They sold 7,000 cars. That's a big thing, that Motors, they've leapfrogged Toyota. They're now the top sellers. Volkswagen was third with 5,000 units. Bentleys, 2 Bentleys were sold. 2 Ferraris were sold. Lamborghinis, 10 were sold. And Porsches, 166. Very important, the GDP figures came out yesterday. For the first quarter, quarter on quarter is up 1.9%, and year on year it was up 3%. What is important is that these figures were much better than expected, and it's also back to the pre-pandemic level. So we're back to 2020 again. That's all for me. Thank you very much, Nick.
Thank you very much, Gielie.